Hello, and today we are going to discuss financial formulas to know for three different financial markets. First, let's finish our discussion about treasury bonds. Breakout inflation is a way to compare treasury bonds and treasury inflation-protected securities. The formula is the yield of treasury bonds minus the yield of treasury inflation-protected securities. As inflation increases, the value of TIPS yield increases because they are protected from inflation while treasury yields are not. That brings break-even inflation closer to zero. The second formula is for the premium of corporate bonds. It is easiest to remember the formula as treasury yield plus default risk premium. Why is this true? Because treasury bonds do not have any default risk. This added risk increases the yield and increases the expected return. Corporate bonds have a push-pull phenomenon. During recession, default risk premium increases dramatically as higher chance company can pay back bond, but treasury yield decreases to increase investments. Therefore, if you think an economic recovery is imminent, then it is wise to invest in corporate bonds. The next financial market is my personal favorite, venture capital and private equity. Entrepreneurs should be aware of what venture capital and private equity companies value when looking at a company's financial statements. One of the most important formulas is monthly cash burn, which is the amount of cash sales minus cash expenses. This determinant helps investors assess whether the company is poorly utilizing their liquid assets and if sales will be able to keep up with attempts to expand their company. Our last financial market you have certainly heard of already, and that is the stock market. When evaluating a stock and assessing their expected return versus the risk, we should know the Sharpe ratio and the Sortino ratio. The Sharpe ratio is calculated by taking the expected or actual return and subtracting the risk-free rate. Take that number and divide it by the standard deviation. The Sortino ratio is very similar, however instead of the risk-free rate, it is the minimum acceptable return. And instead of the standard deviation, it is the deviation of all the negative daily returns. Therefore, Sharpe ratio is affected by large positive and negative deviations, while Sortino is only focused on the large losses that could occur. Alright, that was a lot of information. So let's recap. The break-even inflation formula is the yield of treasury bonds minus the yield of treasury inflation-protected securities. The risk premium of corporate bonds is real rate plus inflation premium plus maturity premium plus default risk premium. This could also be stated by saying treasury yield plus default risk premium. Cash burn is equal to cash sales, cash expenses. And lastly, the Sharpe ratio is expected or actual return minus risk-free. Thanks for watching. See you next week.